All right. What is up, traders? What's up, tycoons? Very excited for today's video. The reason being is it is option expiration day. Okay, it is OPEX Friday. So with that being said, I was able to, have a lot of options expire out of the money that I sold. Okay, using the wheel strategy, which is where you sell cash secured puts and covered calls. So we'll take a look and break down all of the cash secured puts and covered calls, how I was able to collect $395 on this account in passive income, completely passive. All I had to do was click a couple buttons that were very low risk. Okay. And I was also able to, tolerate the risk in case any of those did get exercised and ended up in the money. But before we do that, we're going to go ahead and jump into the dividend portfolio right here. Okay, so you can see some of the positions that we have in here. Currently, we are up 20% on the year, and this is basically on the total book value invested, right? So we have 38,000 of the portfolio invested. That currently has a market value of 47,712. We've got 13,000 cash in here with $500 in monthly reoccurring deposits. Okay. Now this is important because, the cash, all right, the cash is what's very important. It's definitely a very important time to keep a lot of cash on the sidelines. Who knows how long this bear market is going to last, but we're going to go and break down some of the positions that really are enabling me to, be up still significantly on the year. At times when, the S&P 500 was down like 20%, this portfolio is up 20%. So it's outperforming the market by a landslide. A large part of that has to do with dividends. We also got a dividend payout this week. So we'll go ahead and take a look at that one. That was KMB. Okay, this is Kimberly Clark Corp. This is a consumer discretionary stock. I got into this stock at 114.91 with 50 shares, so just under $115. Currently at market close today, this stock was up 1.96%. All right, the total percentage gain on this position is 14.35%. Now, one of the reasons that I'm in this play is because it's a little bit of a defensive play. All right. And then also because of the dividend payout. Okay. So, the dividend payout was November 14th. We get 464 a share. So, you can do the math on that. Was able to collect, a few $100 or a couple $100 on that. That's nice. That's more passive income on top of the $400 that we generated with the, running the wheel strategy. Okay. What's really nice about this, spreadsheet we have here is you can see the 90-day chart. And can you guys tell it's been a bear market? I mean, pretty much most of these stocks are in a downtrend, right? There are a few that have been showing some really nice, attempts at a reversal and, some more recent uptrends, right? We have the, basically the cannabis ETF, MJ. Okay, if you take a look over here, MJ has been performing pretty well here recently. That position is up pretty nicely as well, about 18%. Okay, bingo, all right, which is BNGO. That position is up 17% since I got in. Not a huge section of the portfolio, but biotech is a very interesting sector right now. Okay, health and biotech are seen as a little bit more defensive right now. Biotech is much more risky than some of the traditional health plays, but with higher risk comes higher reward. So it's all about managing that risk to reward ratio. This is only 1% of the portfolio, so it is a small position, but I do own 200 shares, so I am able to sell covered calls against those and just generate a little bit of some extra passive income. Right? We can take a look at the option side of this. And bingo specifically, we were able to generate a little bit of money. Okay, I had a really nice rally. As you looked on that 90-day chart. Okay, so what I did was I sold the 4 strike for January 2023. Okay, and was able to get $17 a contract for those. Sold 2 of those because we own 200 shares. So it's not much. That's about $34. But when you look at how much of the book value that is really invested in this, and you take a look at bingo, right? We have about $420, right? Shout out 420. We have $420 there, and I was able to generate $34 off of the option premium. So if you think about how many shares that can buy, that can buy about 17 shares. Let's just call it 15 shares. Okay. That's pretty nice. Okay. You can kind of think of that as like free shares right now. I'm not really using the money generated from, selling these options to, necessarily buy more shares of whatever stock I'm selling the options on, really just doing it to, collect some, passive income in this portfolio and build it more. So that way, the next time that we do have a pullback, if we do create new lows in the market, I can go shopping again and take a look at, what positions in my portfolio are down the most that perhaps I want to add to, what positions I want to cut that are down the most, and, what positions that I want to trim along the way on the uptrends. Okay. Now, the biggest position, all right, is not a coincidence that it's Gush. Okay, now this is actually the oil and gas bullish ETF, right? And it does have a dividend payout, nothing big, nothing amazing, right? It's 450 dividend per share, but the shares currently are $188 a piece. I have 110 shares of this. So this is about 43.5% of the portfolio. If we go to the portfolio breakdown, you can see that right here that it is 43% of the portfolio is my largest position by far. And the reason being is that this has been a very, very rough year for tech. And for growth stocks. Okay. Now, a lot of times what you see is you see energy outperform the market in bear markets. That's one of the leading signs of, a bear market. Okay. Is you have XLE and you have the energy sector leading the way. So, I kind of got a head start into this with really all of the things that I was seeing this time last year in, October, November, December of 2021. There were a lot of bad signals, and Gush was just very, very cheap. And, the bullish setup on it was very, very nice. So I did get lucky with this portfolio, really making energy my highest, percentage. And then the rest of it is, I still have about 60%, invested in other things besides energy. So at the end of the day, you have about 40% as your hedge. Okay. And then the other 60% is mostly all growth stocks, right? I do have the KMB in there, which is a little bit defensive, but it's more of a dividend play. If you look at the asset allocation, okay, on this portfolio, what we can see is we have 62% of the portfolio is in dividend stocks. All right. Now, yes, you do have to pay taxes on dividend stocks. So that's something you have to, or not dividend stocks, but on dividends themselves, you have to pay taxes. So always keep that in mind if you are building a dividend portfolio and trying to generate the passive income. You do have to pay taxes on, all of that cash that you're collecting. Okay. But when it comes to the rest, right, I have a very small position in crypto, small exposure. Now, I do believe in blockchain technology, but obviously FTX has kind of ruined the whole sentiment really right now in cryptocurrency. Which is why this has never really been a big position in this portfolio. It's only 1%, because if cryptocurrency really does explode sometime in the near future, then that 1% of the portfolio will grow to a much larger percentage, right? Now, if you want to know what stock that I'm in that has, exposure to cryptocurrency, what it is it's BKKT, and this is backed holdings. The reason that I chose this company versus something like Riot Blockchain, the miner companies, okay, is one, because a lot of those miners are going to be getting crushed in the future, right? Not only by the price of Bitcoin, but really it's going to be from regulatory standards. Okay. There's a very, very big movement on making, cryptocurrency carbon negative, at least carbon neutral, right? And these things are using up so much energy, and it's been a real environmental concern. So I'm not personally looking at any miners. I wouldn't suggest them to anybody unless you can find some companies that are carbon neutral, or working on ways to get carbon negative. But the real reason also is because Backed Holdings is owned, their parent company is the ICE. Okay, this is the Intercontinental Exchange. Guess what other company they own, right? They actually own the NYSE, okay, which is the New York Stock Exchange. So you tell me, when crypto, finally does see regulation, okay, and regulation is going to open up the doors for mass institutional global adoption, and this is going to bring in trillions with a T, not billions, but trillions into the cryptocurrency atmosphere and blockchain technology. What company in the stock market is, going to be one of the better positioned companies? Well, I think that Backed Holdings, being that they're owned by the same company that owns the New York Stock Exchange, I think that that's going to work out in their favor a lot and really give them a lot of advantages. Okay. But again, it's a very small percentage of this portfolio. We'll go back down to the sector allocation right here and asset allocation, and finish going through that before we wrap up the video. Real quick, if you enjoy any of this content, make sure to let me know in the comments below. If I've said anything you disagree with in this video, definitely make sure to comment below as well. Let me know your thoughts, what you disagree on, or some of the things you do agree on. And also smash the like button and subscribe to the channel, because I'm doing these portfolio updates pretty much at least once a week, sometimes more, just depending on, how my time is spent up. But water is something that I really wanted to bring to your attention as well with the asset allocation right here. And specifically, I don't have one specific water company that I recommend, but what I actually have is the water ETF right here. Okay, so ticker symbol PHO. I call it pho because I love to eat pho. Okay, I love me some noodles. Send me those nudes. But yeah, anyways, on a serious note, it's the water resources ETF. Okay, now why is this a pretty large portion of the portfolio? It's about 10.9%. It's really like my third or fourth highest position. Well, the reason being is that with, the world is expected to go on a global water shortage as soon as 2025 to about 2030. Okay, so a lot of billionaires are really accumulating their wealth into water right now. They're either buying land, and they're buying all the farmland that they can buy, or they're buying water, right? So what I'm doing is I'm trying to copy and mimic what some of the richest people in the world are doing, right? I'm nowhere near one of the richest people in the world, but if you can emulate and replicate what some of these people are doing, then there's a slight chance that you can have some of their success. Okay, and the reason being is that they're buying all this farmland and this water is that is a finite resource. Okay, there's only a limited amount of water, there's only a limited amount of land, and global population is just going to most likely increase as time goes on, and there's going to be less land available but more people. Okay, and it's going to be less water available for the more people as well. Right now, that's all considering that we don't have World War III and have a nuclear catastrophe and nuclear war going on. There is an escalating crisis with Ukraine and Russia, China, North Korea, things like that. So you do have to be aware of those. But we'll go back down into here and break down some of the positions again. All right, and so we can see that I have about 9.1% in growth, okay, 1% in biotech, and I've got 15.5% in ETFs. All right, now the ETF that I like the most, okay, is going to be SPY-G, which is the SPY growth sector. It's the growth ETF of the S&P 500. The number one reason I like this is honestly the price point. Okay, so I was able to get into this at $50.56 a share. It's currently $53.39. And what that does is that really lowers your price point to sell covered calls on the S&P 500. All right, it's about 244, maybe 255 of the top growth companies in the S&P 500. So in my opinion, there's a lot of companies in the S&P 500 that really don't see any inflows besides the inflows that they get from the index and being indexed in. All right. I can't name all 500 companies off the top of my head. I'm sure you can't either. Everybody knows, is most familiar with the top 50, maybe even the top 100. But a lot of these other stocks, really, they aren't seeing inflows from individual buyers, whether those are institutional or retail. They're really just seeing inflows from being indexed into the market, right? And so if they were to get replaced, okay, or another company starts to really grow and outperform and becomes one of the top 500 stocks in the world, then they could get replaced, right? So I'm not really looking to invest in any of those and have any of those in my portfolio. I'm, much more bullish on growth. But now is a time to hedge against that, which is why I have, the very large exposure to energy, right? So in case those things go down, I have a very big position in energy that I can take profits on, and just slowly accumulate more and more shares of the SPY-G. Now, again, the price point is also very nice. You can buy 100 shares for around $5,000 if you wanted, to sell some covered calls and generate some passive income. If you wanted to do that with the SPY ETF, SPY, you're going to need like $40,000, right? That thing is close to $400 a share right now at the time of this recording. So it's a much big price difference, right? If I wanted to own 100 shares of that, that would pretty much be most of this portfolio, and I wouldn't be able to have much exposure to anything else. All right. Now I do have plenty of positions that I'm down on. Okay. BKKT, one of them. Okay. Obviously, crypto has been just, sucking a whole lot. We have Jumia. Jumia recently tanked a lot. But I'm comfortable with my position. Again, it's a small position of the portfolio, 1.9%. I wouldn't mind building it out some more. There's a lot of companies that have a lot of potential. But it's just a matter of, can they withstand this bear market? And will they be able to generate good earnings in the future? Because ultimately, that's what this current market environment respects. It respects current earnings, profits, things like that, and not so much future growth. They're not really pricing in a lot of growth right now. They want to see good data now, and if you don't have good data, then they're not going to really respect the share price. Okay. Fubo is another one, down about 26% on Fubo. But not too big of a position in the portfolio. I wouldn't mind building out Fubo a little bit more as well. I have about 300 shares of Fubo in this portfolio, so not too bad. And Gilt has been pretty much my biggest loser. I have gotten in and out of a lot of these positions and bought, most of these positions here recently. When I say recently, I mean like in the past 2 months. And so that's why a lot of these are able to be green, with the exception of energy. It's all about timing the market. Now, I know a lot of people say not to time the market and it's better to have time in the market. But when I say time the market, what I mean is not buying when everything is rallying, right? What I'm doing is I'm waiting for things to come down, make new lows. And that's when I'm interested in purchasing, right? I want to, buy things when they're low and typically sell when they're high, right? That's the whole strategy. That's the easiest rule. That's the most common thing that people have heard of, but it's pretty hard, right? So one way to keep yourself busy is, again, selling some cash secured puts, selling some covered calls. That'll keep you interested and keep you active enough to where you're not so worried about anytime something rallies. You want to buy. You really want to buy when things at a lower price point, right? That's what I'm doing is I'm establishing a position at prices I'm comfortable at, and then I already know the price targets in the future at which I want to buy them at in case they come down to those levels, right? And so that's one of the main the main benefits of cash secured puts is that you can actually use the wheel strategy to pick what price you want to own shares at, right? So Zim, for instance, ticker symbol ZIM. um, I wouldn't mind getting back in at $23 a share. All right. If we look at my position on this one, currently my average cost is right around $26. Okay. So it's currently at 24.78. If it going to expire next Friday at $23 or below, all right, then I'll be forced to buy 200 shares of Zim. Now, what's the reason that I want to buy 200 shares of Zim for? Well, it's because of its insane dividend yield. Okay. It pays $27.10 dividend per share. Okay. Now, they only do one dividend payout a year. So, plenty of time to stack and collect. But look at the dividend yield, guys. It's over 100%. It's a 109% dividend yield, bringing in about $207 in this portfolio just in dividends alone, right? And if we look at the book value is 2,600. So even if this position was to go down 50% and only be worth $1,300, I'm still going to collect that dividend payout. Okay, still going to get that $2,710 or $2,710 in dividends. So not saying that you guys should buy Zim. It is a little bit of a red flag when you see stocks, paying such a high dividend. A lot of times, they're trying to attract investors because, using a very high dividend because they can't really attract investors in other ways. But I work in logistics, I work in supply chain, and this is an integrated shipping service company. Specifically in my city, there's Zim containers all around. If you live near a port, I'm sure that probably will see some, trucks driving by with a container that says ZIM on it, right? So, that industry, I do have a little bit of, some inside knowledge in the industry itself. So I don't mind, getting into this when it really has such a very high dividend. Okay. We go back here to the option chain, and we can look at bingo. I broke down bingo a little bit earlier, but look at the cash secured puts. I'm selling the 1.5 strike, right? So, I showed you guys earlier, the average cost is in the $2 range. I don't mind buying more at $1.50. Now with Fubo, right? I'm looking to buy more Fubo when it's around $2.5 a share. Okay. I have the December 16th, 2022 expiration. So this means that if Fubo, completely keeps heading south over the next month, and by December 16th, it's below $2.50 a share, I'm going to purchase 200 shares of Fubo, right? So that's me naming my price. And what I did was actually collected $18 per contract. So that's $36 in total, right? At 2.5 a share, that's a nice handful of shares that if I wanted to, I could actually buy into more, more than 200, right? I can come in and buy 210, 215 shares, whatever the math comes to exactly. But, at the end of the day, really just looking to collect premium. All right. And also name the price that I want to own shares at. Now, Jumia, I have the 4 strike, okay, for November 18th. I also sold the covered calls right here. When you sell covered calls and cash secured puts, that's what's known as the wheel, okay, and you can just keep running the wheel. You just have to be comfortable either selling your shares at the price that you choose for your covered call, or buying the shares and holding the shares for the price you choose for your cash secured puts. The last thing you want to do is sell an option contract, have it run in the money, and then basically buy that option contract back because you regret it and you don't want to actually sell or buy the shares according to your option contract. Now, Gush is very nice, which is one of the main reasons that I made sure I had more than 100 shares. I did have 120 shares, or maybe 125. But I'm down to 110 shares. I have been trimming that position a little bit, just taking some profit, having some extra cash on the sideline. But these expired today. Was able to collect $235 a contract, selling the covered calls with the 225 strike, right? If we look at the price that I got in on Gush, okay, that is $110. So I'm very, very comfortable if today at this Friday, if it would have sold, if it would have went up to 225 and I would have been forced to sell, that would have been over 100% on those shares. And then I can take all of those profits and use them somewhere else, or use that to sell some more cash secured puts, whatever I really want to do, and still have a couple shares left over. So that's very nice. And Gush is really nice. The higher the price of your stock is, the more premium that you're really going to be able to generate selling options, whether they're cash secured puts or covered calls. And then on SpyG here, we had the cash secured puts expire worthless today, the 45 strike. Again, I believe my average cost is around $50 on that. So I don't mind buying in at a cheaper price. The cheaper price I chose was $45, and I was able to collect about $30 in premium for doing that. Again, $400 in completely passive income, just selling options. Okay. And then I got about $200 or $300 in dividend payouts as well this week. So ultimately, it's about $600-700 in passive income I was able to generate about this week, in about 1 week of time. That's very nice, especially in these bear markets when things are uncertain. Okay, so appreciate you watching the video. If you made it this far into the video, you're really going to enjoy one of these next videos as well.